this session, you will evaluate the results of a pair strategy. You will construct a trade blotter, quantify and implement a trading rule, and use 6 performance metrics to evaluate your trade. Based on your rules, you would have traded various pairs. You need to create a trade blotter to record all of it. You will record the pair you trade, the direction of the trade, the entry date, the entry level, the exit level, and the exit category, whether it was profitably exited or stopped out. Now we will focus on quantifying and implementing a trading rule. In the previous section, we discussed the idea of using principal components to determine suitable pairs. You might have a trading rule that uses the second principal component to form viable pairs for trading. That means on a given day, you will have a pair of stocks like KLAC and ADSK. However, if you update the principal components, you may find a different pair to trade. As you use the different amounts or periods of history, you get different data sets. When you compute the principal components on these data sets, you get different results. Suppose you want to place a mean reverting trade. Suppose KLAC and ADSK move apart a certain amount, say more than $30. Your proposed model says that you should sell short the stock that has done better and buy the stock that has done poorly. If the spread narrows, then cover the short and sell the long position. Let's quantify your trading rule. Typically, you will have an entry signal, a profit target, and a stop loss. If the price spread between KLAC and ADSK is greater than $30, you enter the trade. Your profit target is when the price spread between KLAC and ADSK is less than $25. Your stop loss is when the price spread between KLAC and ADSK exceeds $35. Your timeout will be 1 month from when you enter the trade. Now we will focus on backtesting and evaluating the performance of your trading rule. You would now proceed to observe historical data and apply these trading rules. Doing so will produce a trade blotter. Adjusting the rules will produce a different trade blotter. How do you measure your performance? We should be able to quantify this very objectively. Now we are going to look at 6 key measures of profitability and risk of your trading rule. First, you have your percentage of wins. When you hit your target, you consider that a win. When you hit your stop loss, you consider that a loss. Many traders want rules that have 75% or 80% win ratio to put the odds comfortably in their favor. Trades are rarely break even because of fixed costs and market impact costs such as the bid-ask spread. Second, you should calculate your total return. You invested an amount of money on the long side. On the short side, ironically, you don't need funds up front because you borrow the stock. You should look at how much money was put into the trade and how much came out net of costs. Third, you have your average win and loss amounts. Even a trade that is more likely to win can be unprofitable. If you only expect to make $1 but lose $10, you can win a majority of the trades but still lose money. These average wins and losses take both the long and the short side into account. You don't need to detail which side made or lost money, as the goal is outperformance. If the long side has a larger gain or the short side has a greater loss, your trade has outperformed. Fourth, you have your extreme win and loss amounts. The extreme is a single statistic to be sure, but you want to ensure that the results are not skewed such that one extreme result accounts for most of the expected sizes of wins and losses. Fifth, you compute the variance of your returns. Here is where volatility comes in. If the returns are wildly different, you have uncertain outcomes. You have to wonder if you are just lucky or if you're really skilled at picking stocks. Information ratios are used by traders and investors to gauge whether a strategy or manager is skillful or just lucky. It adjusts the alpha of a strategy for the volatility of the strategy's return. 6, you draw a graph that indicates the portfolio value. Every completed trade will add or subtract to your portfolio. Ideally, this line will increase over time and be fairly constant. You can quantify it by taking the correlation between your market value graph and a linear trend of the market value graph. Ideally, you would like a trading rule that makes money quickly and steadily. That is, you don't lose money. In reality, you'd be happy to use a trading rule that makes money steadily. If the P&L line oscillates wildly, then you may be unlucky or enter trades that lose you quite a bit of money. Ideally, this line would be very smooth. If you have various trading strategies, you can take the second derivative of this portfolio value. Then you can compute in discrete time the second derivative. Then you integrate. You would prefer a line whose integrated second derivative is at a minimum. Here you are essentially penalizing for bumpiness.